In Quick Study 2.7, we're going to look at changes in particular accounts, and what we're trying to determine is whether that change is going to be reflected as a debit or credit in that account. So, for example, our first example is to increase store supplies. Now, the temptation might be to try to memorize all the different accounts like store supplies, interest payable, retained earnings, and the like, and memorize all of those and determine is it an increase or decrease recorded as a debit or credit. That can be a temptation, but that's a lot of accounts to memorize. I instead recommend thinking about what are the main classifications of accounts. So, for example, what I mean by that is assets, liabilities, equity, dividends, revenues, and expenses. I recommend trying to make sure you master the rules of debit and credit for those categories in general. So that would be the first step. The second step then is figuring out, okay, if I have a particular example of an account, for example, like store supplies, if I've already got the major classifications done of, for example, an asset being increased with a debit, a liability increased with a credit, then let me think about this individual account, figure out what major category it falls within, and then the rules of debits and credits flow easier, and I'm only having to learn major classifications. So I recommend doing it from that perspective. So that's how I'm going to flow along with this particular problem. So to increase store supplies, I'm going to first step back and think about, is this an asset, liability, revenue, equity, dividends, or expenses? So store supplies are an example of an asset. Assets follow the normal left-hand rule. Keep in mind they're on the left side of the accounting equation, so they're going to be increased on the left-hand side or the debit. So our answer is going to be debit. Our next example of an account is going to be note receivable. Note receivable, an example might be that you've loaned someone money and your expectation, one would hope, is that they're going to pay it back. So you've got a future benefit of your expectation is you're going to be paid back. Keep in mind, receivable is going to be a good clue that this is an asset. When you see the word receivable, think asset. You may be more used to seeing the word accounts receivable. And I know at the beginning it can be tricky. There's receivable, there's payable. Which one's an asset? Which one's a liability? I like to think of it like this. From your perspective, that company's perspective, a receivable is something you're expecting to either be paid cash, provided a product, provided a service, whatever it might be. That's an expectation of a benefit to you. That's an asset. A payable, on the other hand, is something you're expecting to pay. So that's an obligation or a liability. This is notes receivable, so it's an asset. We normally increase assets on the left-hand side with a debit, so therefore we would decrease them on the right-hand side with a credit. Our next account is going to be office expenses. Now, we get very lucky with most of our expenses that it's not too much of a secret that it has the word expenses in it, so it doesn't make it too much of a challenge. We'll get to some chapters later on. We'll throw a little wrinkle in with something called cost of goods sold, but to this point, most of your expenses are going to have the word expenses in them. Now, normally you would say this is under the broad category of equity, so wouldn't it follow the normal right-hand rules of being increased with the credit? Keep in mind, expenses or cost of doing business take away equity from the business. It's a cost taken away. So it's not going to follow those normal right-hand rules. Instead, it's going to follow opposite the rules. So instead of being increased with the credit on the right-hand side, it's going to be increased with a debit. Our next account is going to be fees earned. When you see the word earned, think revenue. Now, some revenues have the word revenue in them. Some are a little bit more tricky like this, that it's a little bit open to interpretation. This, for example, might be an account maybe perhaps a lawyer has, that when they've done services for a particular client, they would record the revenue as fees earned. Fees earned is going to follow those normal right-hand rules. Revenues increase equity, so it's going to be increased with the credit on the right-hand side. Our next one is decreasing unearned ticket revenue. This one can throw you a little wrinkle. Remember how I said, a lot of revenues have the word revenue in them, so you might initially look at this and think, well, revenue. So this would follow the right-hand rules. But I want to caution you, whenever you add in the term unearned, it's going to change it from a revenue to a liability. So that's a big hint. Whenever you add the word unearned, it's changing it to a liability. So for example, think of a concert venue. When you're buying tickets, that from that concert venue's perspective, yes, they're receiving cash, but on the other hand, when you initially buy the ticket, they're not earning revenue. They haven't provided the concert. Until the point at which they do, it's recorded as a liability, something like unearned ticket revenue. So unearned ticket revenue is a liability. It follows the normal right-hand rules of being increased with a credit and decreased with a debit. Our next one is decreasing prepaid parking. Similar to the word receivable, when you see the word prepaid, think asset. So that's a future benefit that you paid in advance. Thinking about maybe your semester by semester yearly parking permit that you purchase from IU Southeast to take advantage of parking within our lots. The reality is that you're not going to use that up in 1 week or 1 month, right? So it's not immediately an expense. It's a prepaid benefit to you because you get to park there all semester, all year, depending upon the length of your parking permit. So it's an asset. Assets follow the normal left-hand rules of being increased with a debit or decreased with a credit. To increase interest payable. So receivable meant asset. It's a future benefit. Payable, when you see that word, whether it's accounts payable, notes payable, or in this interest payable, it's going to be a liability. This is an obligation. In this particular interest, you owe interest. In this particular instance, you owe interest. It's an obligation you have to somebody else. So interest payable being a liability follows the normal right-hand rules of being increased with a credit and decreased with a debit. So we're increasing it, we're going to credit it. To decrease equipment. Equipment is an asset. It's increased with a debit and decreased with a credit. And last and not least is to increase retained earnings. Retained earnings is one of the two major categories of equity overall. One is common stock. That's going to be contributions from your stockholders or your owners. The other is retained earnings. That's going to be earnings maintained in the business minus any distributions to your stockholders. It's going to follow the normal right-hand rules for equity of being increased with a credit and decreased with a debit.